Look at these two numbers. Gold is down 1.7% today. Silver is down 5.4% today. Same market, same headlines, same Federal Reserve, same Iran deal, same dollar. But silver is falling 3 times harder than gold. 3 times. Not a little more, not slightly worse. 3 times harder. And if you hold silver right now, that difference is not just a statistic. It is money coming out of your pocket at triple the speed of someone who holds gold. And the question burning in your mind right now, the question I know you came here to get answered, is why? Why is silver falling so much harder? Why is the same news that is hurting gold destroying silver? Is something broken? Is this temporary? Or is this the beginning of something much worse? I am going to answer every single one of those questions today, with real data, with real numbers, with the exact mechanism that is creating this gap between gold and silver right now. And most importantly, I am going to tell you what this means for you specifically, whether you hold silver, whether you are thinking about buying silver, or whether you are just trying to understand what is happening in this market before you make your next move. Stay with me through this entire video. Because the answer to why silver is falling 3 times harder than gold is one of the most important things you can understand about this market right now. And the second half of this video is where I tell you exactly what smart investors are doing with this information. Do not skip it. Let me start with the raw facts on the ground today. It is June 24th, 2026. Silver is trading at $62 per ounce. That is a 6-month low, down 49% from its all-time high of $122 hit on January 29th of this year. Today alone, silver is down 5.4%. Gold is sitting at approximately $4,100 per ounce, also down today, but only 1.7%. The gold-silver ratio, the number that measures how many ounces of silver it takes to buy 1 ounce of gold, has hit 67 today, the highest level since the peak of the Iran war. And that ratio number is the key that unlocks everything I am about to show you. Because when the gold-silver ratio moves this dramatically, it is not random noise. It is a signal, a very specific signal about which forces are dominating this market right now. And understanding that signal is the difference between making a panicked, emotional decision and making a calm, rational one. So let me explain exactly why silver is falling 3 times harder than gold. And I want to go deep on this because most people give you a surface-level answer and leave you more confused than when you started. The real answer requires understanding something fundamental about what silver actually is. Because silver is not what most investors think it is. Most investors think of silver the way they think of gold, as a precious metal, a store of value, a hedge against inflation and currency debasement. And silver is all of those things. But silver is also something else entirely, something that gold is not. Silver is an industrial metal, and that dual identity, precious metal plus industrial metal, is the exact reason silver is falling 3 times harder than gold right now. Let me break this down completely. Gold is almost purely a monetary metal. Think about how gold is actually used in the world. Central banks hold it in vaults. Investors buy it in ETFs and coins and bars. Jewelers use some of it, and that is basically the extent of gold's demand picture. About 90% of gold demand is investment and store of value related. Industrial use of gold is minimal. Gold does not go into solar panels. Gold does not go into electric vehicles at scale. Gold does not go into the circuit boards of artificial intelligence servers. Gold sits in vaults and in portfolios and around people's necks. That is its primary function. And because gold's demand is almost entirely monetary, its price is driven almost entirely by monetary forces. When the Federal Reserve gets hawkish, gold goes down. When the dollar gets stronger, gold goes down. When real interest rates rise, gold goes down. When those monetary forces reverse, gold goes up. It is a relatively clean, one-dimensional relationship. Silver is completely different. Silver has 2 distinct demand engines running simultaneously. The first engine is the monetary engine, the same engine that drives gold. Real yields, dollar direction, inflation expectations, safe haven flows. When this engine is firing, silver moves alongside gold as a monetary asset. And historically, silver actually outperforms gold when this monetary engine is running hot. Silver went up more than gold during the 2020 pandemic recovery. Silver went up more than gold during the 2025 geopolitical uncertainty wave. When the monetary engine fires, silver runs harder and faster than gold in the upside direction. But here is the other side of that coin. When the monetary engine is being suppressed, when the Fed is hawkish, when the dollar is strong, when real yields are high, Silver gets hurt by that suppression just like gold does. First engine damaged, silver goes down. But now here is the critical difference. Silver's second engine is the industrial engine. Silver is one of the most industrially useful materials on Earth. It has the highest electrical conductivity of any element. It has the highest thermal conductivity of any metal. It has natural antibacterial properties. It reflects light more efficiently than any other substance. And these properties make silver absolutely essential in manufacturing, in electronics, in medicine, in energy production. Solar panels use silver paste in their photovoltaic cells to conduct electricity. Every electric vehicle on the road contains between 25 and 50 grams of silver in its electrical systems. Every smartphone contains approximately 1/3 of a gram of silver in its circuitry. Every artificial intelligence data center contains hundreds of kilograms of silver in its server infrastructure. This industrial demand is enormous. It is real. It is growing. And it represents approximately 50 to 60% of total annual silver demand. Now here is where the 3 times harder explanation comes in. When the Federal Reserve gets hawkish and rate hike expectations rise, monetary forces suppress silver just like they suppress gold. First engine damaged for silver, same as gold. But then something happens to silver that does not happen to gold. The market starts worrying about industrial demand. Here is the logic. Higher interest rates slow economic growth. Slower economic growth means less manufacturing activity. Less manufacturing means less demand for industrial metals. Less demand for industrial metals means lower prices for those metals. And because silver is an industrial metal as well as a monetary metal, it gets hit by this concern directly. Gold does not get hit by this concern at all because gold has essentially no industrial demand to worry about. So silver gets hit from 2 directions simultaneously. Monetary headwind from higher rates and dollar strength, shared with gold. Industrial demand concern from growth slowdown fears, unique to silver. And that is why silver falls 3 times harder, 2 forces hitting it at once versus 1 force hitting gold. The mathematics of that double hit produces exactly the kind of ratio expansion we are seeing today. Gold-silver ratio at 67, silver down 5.4%, gold down 1.7%, 3 times harder. Explained completely. But now I want to go even deeper, because there is a third layer to this that almost nobody is talking about, and it is the layer that makes the current silver sell-off even more dramatic than the simple 2-force explanation suggests. That third layer is leverage and positioning. When silver was running from $47 to $122 earlier this year, a lot of investors piled in using leveraged positions, futures contracts, options, leveraged ETFs, margin accounts. When you use leverage, your gains are amplified on the way up, but your losses are also amplified on the way down. And when the price starts falling, leveraged positions get margin called, meaning the broker forces you to sell your position to cover your losses whether you want to sell or not. Those forced sales create additional selling pressure, which pushes the price down further, which triggers more margin calls, which creates more forced selling. This cascade of forced liquidations is a major reason why silver can fall 3 times harder than gold in a short period. Gold holders are predominantly unleveraged central banks, long-term investors, and physical holders who do not face margin calls. Silver holders include a much higher proportion of leveraged traders who do face margin calls. And when those margin calls cascade, the selling is indiscriminate and fast. This is happening right now, and it is adding fuel to the 3 times harder decline on top of the 2-force fundamental explanation. Now let me tell you what all of this means for you, because I did not bring you this far into the explanation just to leave you with theory. I want to give you something practical, something actionable, something that changes how you think about your next decision. The first thing it means for you is this. If you hold silver and you are watching it fall 3 times harder than gold, and you are feeling frustrated or confused or scared, those feelings are completely understandable, but they are based on watching price without understanding mechanism. Now that you understand the mechanism, your decision framework changes. Silver is not falling 3 times harder than gold because silver is fundamentally worse than gold. Silver is falling 3 times harder because it has 2 headwinds instead of 1, and because leveraged positioning is amplifying those headwinds temporarily. When those headwinds reverse, and I am going to tell you exactly what causes them to reverse, silver will also recover faster than gold. 3 times harder on the way down tends to become 3 times harder on the way up. The same dual nature that is hurting silver now will accelerate its recovery when conditions shift. The second thing it means for you is that the gold-silver ratio at 67 is a historically significant signal. Let me give you the data on this because it is genuinely important. In every major precious metals bull market in modern history, the gold-silver ratio has eventually compressed dramatically as silver outperforms gold. In 1979 and 1980, the ratio compressed from 47 to 17 as silver ran to $50 per ounce. In 2011, the ratio compressed from 68 to 32 as silver ran to $49. In 2020, the ratio compressed from 124 to 65 as silver recovered from its COVID crash low of $12 all the way to $29. Every single time, without exception. In a precious metals bull market, silver eventually outperforms gold and the ratio compresses. At 67 today, the ratio is telling you that silver has been beaten down dramatically relative to gold. And historically, that kind of beatdown is not how bull markets end. It is how they reload. At 67 gold-silver ratio, with gold at $4,100, a compression back to 50, which is moderate by historical standards, would imply silver at $82. A compression to 45 would imply silver at $91. A compression to 40 would imply silver at $102. These are not fantasy numbers. These are the historical outcomes that follow extreme ratio readings. The third thing this means for you specifically depends on your personal situation, and I want to address 3 different groups of people watching this video right now, because I know you are not all in the same position. If you are holding silver that you bought at higher prices, and you are sitting on a loss right now, here is what the mechanism tells you. The forces causing your loss are temporary. Fed hawkishness, dollar strength, leveraged position unwinding. These are not permanent structural changes to silver's value. They are cyclical macroeconomic pressures. The question for you is not whether to sell at a loss right now. The question is whether you have the financial and emotional capacity to hold through the temporary pressure until those forces reverse. If you do, the data suggests patience is the rational choice. If you do not, if you are using money you cannot afford to leave tied up for months, then you need to make a decision based on your own circumstances, not on what the chart is doing. If you are sitting on the sidelines watching silver fall and wondering whether now is the time to enter, here is what the mechanism tells you. The immediate risk is tomorrow morning's PCE data at 8:30 a.m. If PCE comes in at 4.1% or above, the current consensus, it will likely extend the selling pressure and silver could test $60 or below. In that scenario, waiting one day gives you the opportunity to potentially buy at an even better price. If PCE comes in softer than expected, silver could snap back hard and fast, and waiting one day might mean you miss the first leg of the recovery. The mechanism cannot tell you which way PCE will print, but it can tell you that the decision point is tomorrow morning at 8:30, and that being prepared for either outcome is more valuable than guessing which one arrives. If you already hold silver at reasonable average prices, and you are thinking about adding more at these levels, here is what the mechanism tells you. Dollar cost averaging at $62, with institutional price targets ranging from $79 to $81 at the conservative end, and $135 to $309 in a physical shortage scenario, is a mathematically sound strategy given the structural fundamentals. The 6-year supply deficit is real. The industrial demand from solar, EVs, and AI is real. The central bank accumulation of gold as a dollar alternative is real. These structural supports have not changed because the dollar index hit 101.5. They are still there, underneath the temporary pressure, waiting. Now let me tell you exactly what causes the 3 times harder decline to reverse. 3 things need to happen. They do not all need to happen at once, but each one that happens removes one of the forces that is currently suppressing silver. First, the PCE data needs to show cooling inflation. If tomorrow's core PCE comes in below 4%, it weakens the case for a September rate hike. Rate hike expectations fall, dollar weakens, silver recovers. This is the fastest potential catalyst. It arrives tomorrow morning at 8:30 a.m. Second, the Iran 60-day peace roadmap needs to hold. Every day the ceasefire holds, oil prices stay lower. Lower oil prices mean lower headline inflation in June and July. Lower inflation means the Fed has less justification for hiking rates. And a Fed with less justification for hiking means the dollar loses its rate hike premium and weakens against other currencies. A weaker dollar is directly bullish for silver. Third, the leveraged long unwinding needs to complete itself. Margin calls calls and forced liquidations are a self-limiting process. Eventually, the weak hands and the over-leveraged positions get flushed out. When they are gone, the selling pressure disappears, and the remaining holders are the strong hands, the long-term investors, the physical buyers, the institutions with price targets far above current levels. When the forced selling is done and only conviction buyers remain, the market finds its floor and recovers. We may be closer to the end of that process than the beginning, given how far silver has already fallen from its January high. Here is the complete picture. Silver is falling 3 times harder than gold today because of 3 simultaneous forces: a monetary headwind from Fed hawkishness and dollar strength, shared with gold, an industrial demand concern from growth slowdown fears, unique to silver, and leveraged position unwinding creating cascading force sales, amplified in silver versus gold. These 3 forces are real, they are powerful, and they have driven silver to 6-month lows at $62, down 49% from its January peak, with the gold-silver ratio at 67, the widest since the Iran war peak. But none of these 3 forces are permanent. PCE data tomorrow could begin to crack the rate hike narrative. Iran deal durability could remove the oil inflation premium, and leveraged position unwinding is self-limiting. It ends when the weak hands are gone. When any one of these forces starts to reverse, silver responds faster than gold, and when all 3 reverse together, silver's dual nature, the same dual nature that made it fall 3 times harder, makes it recover multiple times faster than gold. The gold-silver ratio at 67 is historically one of the most reliable setups for silver outperformance that exists in financial markets, not because it always happens immediately, but because it has always happened eventually. And the smart investors who understand the mechanism, who understand exactly why silver is falling 3 times harder right now, and exactly what needs to change for that to reverse, are the ones who are positioned to benefit when it does. I am John A.G., and this is what we do on this channel. We go deeper. We explain the mechanism. We give you the data and the context that turns a scary headline into a clear decision framework. Tomorrow morning at 8:30 a.m., the PCE number drops. I will be here breaking it down in real time. What it means for silver, what it means for gold, what it means for the 3 forces I explained today. Subscribe now and turn on notifications, because tomorrow is the moment of truth for this market, and you deserve to walk into it with a full understanding of exactly what you are watching and why it matters. I will see you tomorrow morning. Be ready.